Fundsupermart.com.
Given the fund's focus on investment-grade debt, how does it provide meaningful returns to its investors?
The objective of the Premium Bond Fund offers return from capital growth, as well as income from investing into investment-grade securities in Asia. We do actually think that at a treasury spread of about 280 basis points above treasury in the corporate bond area in Asia, in the investment grade, there's a lot of medium-term opportunities. From a fundamental perspective, sovereign fundamental in Asia is generally strong for most of the investment-grade companies. At the same time, inflations are coming down in Asia. That offer a lot of opportunities for the central banks to use monetary policy as well as fiscal policy to support growth if there's a more prolonged slowdown in other parts of the world. And at the same time, the banking sector are very resilient, and yet corporate leverage has actually remained fairly low from a historical standard point of view. So fundamentally, we do find there are attractive opportunities. When we come down to valuation, we do think that given interest rates very low globally, looking at, for example, the Sing dollar deposit rate or US Treasury, actually corporate bond right now offer very good opportunities for investor. And in Asia, generally Asian investment grade corporate bond do offer a meaningful pickup of credit spread against the similarly rated corporate in the US market.
How does the fund manage its currency exposure, and how much does currency contribute to the fund's returns?
The Premium Bond Fund is denominated in Sing dollar, and we don't actually take active currency risk for the fund. Most of the opportunities in corporate bond in Asia is in US dollars market. So as a result, we do invest predominantly in the US dollar market. So what we do is we hedge back most of this exposure back to Sing dollar. However, for diversification aspect, we do actually find there are some interesting opportunity in some area outside the Singapore dollar, for example in RMB. So for example, right now the fund has about 6% of exposure in RMB offshore fixed income, in which you also have about 6% of RMB currency in the funds as well.
Which area within Asia ex-Japan investment grade debt do you see the most opportunities?
We genuinely find corporate offer more value than sovereign bonds and quasi sovereign bond from a valuation point of view. And in terms of country allocation, we are constructive and positive in China, Hong Kong, and Korea. In the case of China, the monetary easing certainly helped the China credit, and we like those state-owned enterprise in which they have good business profile, and at the same time they have pretty strong government support as well. In the case of Hong Kong, there's a lot of new issue in the primary market, and what it really means is the spread are wider as a result, and we do think it is a very good time to accumulate bond position from that. In the case of Korea, fundamental has meaningfully improved from 3 or 4 years ago, and we do actually think that both in the corporate sector as well as selectively in the banks, there are quite interesting opportunity there as well. Lastly, in Singapore, we kind of find valuation is quite fair at the moment. However, there are selective opportunities, some from the banking sector as well as some from government-linked entity, which offer pretty good interesting opportunity, and they are still offering value comparing to the high-quality corporate that we can find in for example, in the US market.
On the other hand, which areas are you less positive on?
In Taiwan, Thailand, and Malaysia, corporate fundamentals are actually quite stable and resilient. However, there were less corporate new issues in the market over the past few years, and hence valuations are getting a bit more expensive. So from a portfolio allocation aspect, we have lower allocation on those places that I mentioned. The one that we have some concern is really coming from India. The growth momentums are continue to be quite weak. And at the same time, liquidity for the domestic corporates are tight. And there are also some risks of a sovereign downgrades in the next 6 to 9 months time. And as a result, that could have some negative implication to credit spread. From the allocation to portfolio, we have less allocation to India as a result at this moment.